Okay, good morning, everyone, and welcome back to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. We have a lot to go over here today as we are about to open up a little bit weaker than we closed yesterday. I think might be the second consecutive down day we're currently having in the markets. So today what I want to do is I want to go over some of the charts. I want to spend some time going over charts because there are a lot of sectors here that are currently moving. Over the last couple of weeks, things have been relatively quiet, I would say stable, but that is starting to shift again a little bit this morning. So I want to discuss what sectors are on the move, what opportunities we currently see in the markets. Now, if everyone can hear me, please bring up your chat window at the bottom of your screen and just please type yes if you can hear me loud and clear. Okay, perfect. So, like I said, a lot to go over here, but before I do, just a quick disclaimer. Everything we're going to discuss here is purely for demonstration purposes. It is not a recommendation or solicitation to buy or sell any specific securities. So, let's first start with the current market outlook. And if we look at the markets over the last few weeks, you would think that we are in a much better position than we were a couple of weeks ago. Markets have rallied roughly 50%, almost 60% from its initial sell-off. For those of you that have been following us for the past few weeks, we've had this pretty strong rally, this almost V-shaped recovery. And as you can see here on the hourly charts, what we've had is a fairly consistent move higher, very, I would say, orderly move higher, where the markets would open a little higher each day, maybe grind a little lower, then open higher, then grind a little lower, and over again. But every single time we've pushed higher, momentum has continued to shift lower and lower. And we've had this massive negative divergence that the longer it goes on for, the higher the likelihood of a larger pullback here. And I think we're starting to see the beginning of that to this morning. So the markets are opening around 276 right now, which is below the Friday gap higher. Pretty much every other move higher has resulted in at least continuations higher and higher lows. And the question is whether today we'll put in a lower low, which might again signify that 284 is a major resistance level that for now the markets have at least exhausted this move higher, and it's going to need a check back before it can potentially retest that 284 resistance. The fact that we're above 243 still puts us in a bit of a, I would say, mildly bullish to neutral state. But above 284, that's really where we can see some continuation up to 302. But I want to show you some of the things that we're looking at today as far as, whether or not the markets continue moving higher is yet to be seen. But there are certainly some sectors that we are paying attention to that give us some clues or at least provide us some opportunities. So a lot of things to want to talk about. First thing, again, that 284 rejection at the SPY is certainly a major number to keep an eye out for, because a rejection at 284 does provide an opportunity for the markets to start moving lower. It's hard to fight the Fed right now, so I don't necessarily think it's time to go outright short the markets, but I think there are some weaker sectors that we can pay attention to. The big headline that I think we should focus our attention on right now, because if you just look at the equity markets, you would think that markets are in a much better position. Things are looking much better. I think the markets right now are taking a very optimistic approach to how to look at everything from the coronavirus trends, from reopening our economy, from the Fed providing stimulus and supporting the unemployed and the businesses that need to stay open. Everything from an equity markets perspective looks pretty good. But if you look at things like oil, and for those of you that have been following this story over the last couple of days, I think this really speaks more to where the market truly is right now. The dislocation that we're currently seeing in the oil markets, where basically futures contracts are being sold at negative numbers just so to avoid physical delivery. No one wants to take physical delivery of oil right now because there's too much oil out there. And that speaks to the true demand for what normally is a normally functioning economy. Oil priced at $15 a barrel, especially after we've gone through all these cuts, especially all the rig counts have been steadily declining for quite some time now. And oil still at $15 speaks to, in my opinion, more of the true economic impact that this COVID-19 has had on our global economy versus where the S&P 500 is currently suggesting, if you will, which is much more of an optimistic tone. So I think there needs to be a bit of a reconnection, if you will, of reality with where the markets currently are. How that's going to shake out, when that's going to shake out is hard to say, because markets can obviously remain there's a saying that we typically have, is that markets can stay irrational longer than you can stay solvent. So be careful about this. So what I want to, again, is focus more so on specific sectors. The other one I want to talk about is VIX, right? So VIX has been declining pretty consistently for quite some time, from that $84 high down to about 35. 35 is a pretty major threshold. And now we're just starting to push back higher, as you can see here on the hourly chart here on the right-hand side. On the hourly chart, you have a fairly, I would say almost like a base building here, where you've had this continuous decline in volatility, a bit of a double bottom here around 38, and now we've just pushed back higher. So this is definitely suggesting that at least market participants are paying perhaps now for buying some more puts. We certainly have seen a lot of put buying on the markets right now. A lot of people trying to hedge their exposure for potentially another sell-off. Again, just because there are participants buying puts does not mean that there's going to be a correction. It just means that there's a higher probability of correction, and many investors are trying to protect themselves against a potential correction. So that is some of the risks that we're currently seeing in the markets. With that, again, I think oil really speaks to, in my opinion, the true a better indicator as to where current markets are. CocaCola also just reported earnings, and I usually think of Coca-Cola as a pretty good bellwether for how the general global economy is doing. It's a product that's relatively cheap. It's not something that you'll go out and splurge on per se. So the fact that Coca-Cola has seen demand fall by 25% just in March and going into April, I think that speaks to some of the weakness that we're currently seeing. And a lot of the charts we're going to look at today look very similar to this type of Coca-Cola. And this type of momentum that I'm talking about, that we saw in the S&P 500, as markets continue to move sideways, momentum continues to move lower. That's the type of weakness and the exhaustion that we're currently seeing in these types of rallies. We've seen so many stocks rally off their lows, but most of those stocks, you'll notice that the momentum has continued to move lower. Now, for those of you that have watched my videos on technical analysis, you'll remember that I speak very heavily to telling that just because there's that divergence, what divergence doesn't tell you is how far a stock will go. What divergence tells you is that the direction that it's likely going to go in, but divergence in itself doesn't tell you whether it'll move $1 lower or $10 lower. So there's no way that we can tell just from that divergence as far as how far things can go. We do need to turn to fundamentals and other aspects of technical analysis to gain that type of view. So I want to take a look at some of the sectors and hopefully come up with some of those views. So first of all, we want to take a look at emerging markets. Emerging markets has been predominantly left out of this rally for the most part. As you can see, after that initial fall, it really has barely recovered about 30% of that initial move, versus the US markets have recovered 50, 60%. We are currently still in this bear market here for emerging markets. And just similarly like the equity markets, as the markets continue to grind a little higher, momentum continues to shift lower. So we've got this negative divergence, which again points to a high probability of a check back. That's exactly what we're seeing this morning. Now, this check back could be minor. It could pull back to 34 and then start moving higher. That's always a possibility. But we're seeing so many of these divergences across so many sectors that I think we have a pretty high probability of at least a small check back here before the markets can resume moving higher. So what that means is that if you're in the position right now where you're saying, I'm missing out on this rally, right? I see that markets are moving higher. I want to go long. My suggestion to you is wait for a bigger check back here, at least 2 to 3% before you consider getting into some longs, perhaps selling some put options, put spreads in that time, or maybe buying some calls might make sense because a lot of calls right now, especially slightly out of the money calls, are pretty cheap. If you're looking to play a bounce, I would wait for a pullback like today to get into some of those longer term bullish plays. But again, what we want to do is we want to take a look at some of the different sectors here. So there's a clear bifurcation right now between the different sectors, strong sectors and weak sectors. One of the strongest sectors has been healthcare, specifically the biotech names. So if we look at the biotech names, what's really interesting is that yesterday we broke out above a pretty major, I would say, let's just call it a triple top here, where you've had this 1, 2, 3 times the ETF was rejected around this 123 level, if you will, gapped up higher and is starting to move higher. So if you zoom in on the daily chart, gapped up above that 123 level, pulled back a little. It's hovering around 126, and I think you might see this continuation higher. A lot of this is on the optimism of different pharmaceutical companies that will create some kind of vaccine or drug to cure coronavirus. From my perspective, it makes more sense to buy one of these indices as opposed to individual names, because you just simply have too much single stock risk that it's impossible to predict which company is going to come out with some kind of solution first, or which one's going to have, better results in a clinical trial. It's just too much risk in picking an individual stock. You're better off looking at the whole sector. And IBB clearly is the winner here for making a play on a coronavirus, whether it's a vaccine or some kind of cure. So, this is one of the strongest sectors right now, and this is where I would focus our attention on. Same thing with healthcare. Healthcare has obviously taken the same type of approach, but obviously healthcare XLV has a lot of other companies in there, not just pharmaceutical companies. So obviously has not rallied as strong, and certainly has not broke out the new 52-week high. But I would anticipate that XLV might, on a pullback, maybe make another run towards that 52-week high, but certainly not as strong as IBB, the the biotech ETF. Now, what I do want to point out too is a current dislocation that we're seeing with consumer discretionary and consumer staples. So, given the current environment, obviously consumers are spending a lot more on staples, stocking up on everything from toilet paper to food to things that they need to survive in this lockdown period, versus consumer discretionary goods like clothing and things like that. And if we look at the credit card data, which we've been looking at for the last few weeks on our morning outlooks, the data is very clear. There's an increase in spending on staples. There's a significant decrease in spending on consumer discretionary sectors. Yet, if you look at the consumer discretionary XLY ETF, you would think that that's not the case, because the markets have now rallied very strongly off of that low, not reflecting the data that we're currently looking at. And one of the reasons that I want to point this out, and for those of you that watch CNBC this Friday, where Carter and Mike put out a short trade on XLY, one of the things to keep a reminder here, and this is true right now for the overall market as well, is that XLY is predominantly made up of 5 stocks: Amazon, Home Depot, McDonald's, Starbucks, and Nike. Of which Amazon and Home Depot have actually seen a significant increase in spending. So even though this falls under the consumer discretionary sector, you're talking about one company that makes up almost a quarter of the entire ETF that I think may fall a little bit under both of the staples and the discretionary umbrella. So you have this XLY ETF that gets dragged higher as a result of Amazon continuing to move higher. We look at a chart like Amazon. There are almost no other stocks that look like this. If you just look at this chart, and I didn't tell you what stock it was, you'd think that you were looking at a pharmaceutical company that's creating a virus, a vaccine for COVID-19, not like a consumer discretionary stock. But that's exactly why XLY is being dragged higher. Home Depot, also one of the sectors, one of the sectors that we've seen strong gains in. But I will say on Home Depot, what's interesting here is that I've noticed for quite some time, 210 is a pretty major level here where we, bounced higher off of this, broke finally below it, and now we're retesting as resistance. So far, we're opening up a little lower here around 201. So if Home Depot can break back above 210, that would certainly be, I would say, quite bullish for XLY. But if it stays below 210, then we might start to see XLY start to roll over. Again, XLY, I think, is very distorted here. So if we're looking at consumer discretionary, there are plenty of names that are just a complete bloodbath in this particular space. If you look at the names like Nordstrom and Macy's, very similar charts, where they've barely bounced from their lows, right? So these have $12 lows. They've bounced less than, 20%, 30%, and they're starting to move lower again. So most of the discretionary names actually look more like this than like the XLY, the sector itself. If you look at Macy's, if you look at Burlington stores, Burlington's a little stronger. Nike looks very strong as well, but also, starting to roll over. Looks like it's opening up around 85.50 or so. And if you look at stocks like Nike, similar type thing where you continue to have higher highs where momentum is not moving any higher. So we see a lot of signs of this type of exhaustion in a lot of names, especially in the consumer discretionary space. And we can use options play to we have the watch list built for you to quickly scan for the discretionary names and see where do you have the weakest discretionary names. If you look at some of these names like Gap, PVH, these are down 6-7% yesterday, while the markets were down 1.7%. So there's a lot of things that I think are getting masked right now by the XLY ETF, again, because 40% of the weight is just Amazon and Home Depot. So it's dragging this higher. But if you want to seek for weakness in this particular sector, I think there are plenty of opportunities, even stocks like casino stocks like Wynn, that are really facing some pretty big challenges as far as when they can reopen and kind of when tourism will return back to normal. I think there are a lot of opportunities in names like that. And lastly, let's take a look. Financials. Financials also one of the weaker sectors. Financials have not bounced significantly higher from those lows, and we are now seeing a lot of weak names like Wells Fargo continue to push that new 52-week low, trading right near at the bottom of that range. Same thing with stocks like American Express. This is in the Dow 30. We're talking about, one of the largest financial institutions in the world, about to open up significantly lower here around $81. Again, a lot of weakness here we're seeing in the markets. I think this is going to contribute to potentially some further weakness here in the markets. Looks like we're opening up around 275 or so at the moment. We were trading pre-market around 275, 274. Bounced a little higher earlier when we started around 276. Now it's starting to trade a little lower here. So we expect some weakness here. It's hard to say if today is going to be another day where it opens up early and then just starts to trade higher. That's very possible. But again, there's some cracks showing in the market right now between, if you look at the VIX, if you look at oil, this is showing you that the picture is not rosy. It's not okay. The same way that this V-shaped kind of recovery is sort of indicating, I think there's a bit of a dislocation here with the current market versus where we really are. So those are some of the things that we're currently watching here in the markets. One of the things I will say is that liquidity continues to improve, which is a great thing for options traders because, the number of symbols that we think are very liquid in the option space has increased to 113 names. So that's a much better position to be in, meaning there is a lot more opportunities to pick individual stocks, to trade individual sectors. And looking for opportunities, meaning correlations are not as high. So you see plenty of stocks moving higher, plenty of stocks moving lower. This gives you more opportunity to trade. Also, the earnings season, very important right now. So this week, today we have Netflix at the close, which I think is going to be one that a lot of people are going to be trading. Netflix right now looks really strong. from a relative strength perspective, it's really strong. Pre-market's opening up right around the 52-week high. There's a lot of anticipation that they're going to significantly increase their subscriber base in the US and internationally this particular quarter. So, off of that, I think they're going to have fairly strong revenues, and they're likely going to beat on earnings. This might be a stock to watch going into earnings season. Delta Airlines is a big one. We get a lot of questions regarding when it's time to get back into travel stocks. United Airlines reported yesterday, didn't move significantly lower, so that might show us that, we've found somewhat of an equilibrium here on where these airline stocks should be trading. And let's see if Delta has a similar type result where, the stock doesn't go significantly lower below 20 bucks. If we do get a break below 20 bucks, then I would say game over for some of these travel stocks. They'll probably continue to move lower. I wouldn't get long at this point right now unless you see some more stabilization after Delta reports today. American Airlines later in the week. Intel is also a big one. Semiconductors have been one of the strongest sectors, but I think it's starting to roll over a little, as you can see here in the semiconductor stocks. Very similar story. As the markets continue to move higher, momentum continues to move lower, telling me that these rallies are starting to lose steam. There's some exhaustion here. But again, it could just take a small rally, a small check back like we had here to get the markets to continue to move higher. So I wouldn't outright to go out and short the markets just yet, because you have a fairly decent probability that the stock might continue to move higher. But those are some of the sectors that we're currently paying attention to here in the markets. So with that, I want to thank everyone for taking the time out here this morning. I hope that this was useful in helping you set up your day, understanding where we're currently positioned here in the markets, what opportunities we're currently watching. And again, there are a lot of sectors on the move this morning, so pay attention. I think there are going to be some interesting opportunities coming up this particular week as the markets kind of shake out at that 284 resistance. See how the markets react to it, because 284 is a very major level for us to continue paying attention to. So with that, thank you so much. I hope you guys have a great trading day. Please stay safe, and I will see you guys next week. Thank you so much.